Right, happy Manyi. It's half an hour away to the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China show. I'm David Ingles.
No one ever calls it that, Manyi, by the way. Our top stories this morning: Elon Musk makes an unannounced trip to China, meeting Premier Li Qiang as he seeks to reverse Tesla's revenue decline.
Well, it's certainly Manyi in Chinese markets. Let's see. Industrial profits slumping in March, though the Hang Index is coming off its best week in 11 years. Yen traders on alert for any moves to support the currency.
And we look at the challenges facing China's green energy sector with top solar industry supplier GCL Technology. As David tries to make Manyi a thing, it certainly is a bit of a yay when it comes to markets here if you're long, okay? You take a look at how risk assets are doing here this morning. Asia Pacific, we're seeing gains about a third of 1%. U.S. futures are also punching higher. Certainly what we've been tracking really has been the dovishness when it comes to the BOJ. If you pair that with the potential hawkishness from the Fed this week from Jay Powell, what does that mean for dollar yen, right? We've breached above that 158 level here. We're at 158.24 here. I mean, this is crossing multiple red lines that we've seen from Japan officials already, and yet we haven't seen any signs of intervention. Keep in mind, though, today is a holiday in Japan, so obviously we're going to be seeing liquidity is going to be an issue. It could exacerbate some of these moves and price swings here. So we're seeing that, basically when it comes to euro yen, Aussie yen, all catching a bid here this morning and continuing that weakness when it comes to the Japanese currency. Bond futures are also showing a little bit of green here, although it was, Treasury yields basically gained for a fifth straight week. They still ended slightly on a positive note last week after that PCE data, despite that actually showing stronger than expected spending as well as inflation as well. Brent crude slightly in the back foot, about 1% here. We're back below that $89 level here, and iron ore also down about 1.5%. But watching very closely what happens with some of these tech gauges that we've been really doing quite well last week. Taipei, take a look at that. We're up to 1% right now. Golden Dragon did this on Friday. Keep in mind, we're also watching Singtel. They're saying a second half could be a loss. There's been some impairment provisions that they had to really focus on as well. So that's why you're seeing the stock down in Singapore here. Golden Dragon was a great day on Friday, as you can see, and it really has been really great days when it comes to what's been going on in Chinese markets, right? What a sudden revival that we're seeing here. Hong Kong, basically the Hang Seng, as Dave mentioned, had the best week we've seen since 2011. MSCI China, we're getting nearly close to 20% gains since the January lows as well. Futures are pointing slightly lower, Dave, here right now, and that dollar China trade still at 726.
Yeah, want to watch certainly the rally we're seeing in the CGB market, and as Yvonne was just pointing out, that this rally in equity markets, 8-9% weak. MSCI China Hang Seng Index, Hang Seng Tech Index, of course, doing much better than that as well. So we're looking at that going into the open today, and not to also sideline the rally we're seeing onshore. So CSI 300, 3 days of gains going into this week. There's a 30-year bond auction in China today. We should be getting the details of that in about 90 or so minutes from now. It's hard to underscore as well how big of an earnings week this is for Chinese markets. Some big names on your screens today. I think we're looking at about 200 or 40 and odd companies in MSCI China reporting this week. So that's about 30% of the benchmark, and of course all things Elon Musk, all things EVs. So of course we'll digest that in just a moment there. Dollar China on your screen, 726.54, and some data coming through as far as hotel data out of Macau, and of course property on the back of news out of, I think it was Chengdu, relaxing some of those restrictions on the weekend. Announcement was made, I think, on Sunday as far as that's concerned.
Yeah, let's get to our top story here this morning. Now, Elon Musk is in China on an unannounced trip and seeking approval for a driver assistance software that could help arrest Tesla's revenue decline. We heard from the Tesla CEO in Beijing.
It's good to see electric vehicles making progress in China. All cars will be electric in the future.
For more, let's bring in our Chief North Asia correspondent, Stephen Ingles, in Beijing for us. And you saw this all sort of unfold over the weekend, Steve. What more do we know about this surprise visit from Elon Musk?
Yeah, well, he did fly in. At least we suspect this was the aircraft, and we have the video of that. Our Danny Lee, our aviation expert and EV expert as well, kind of was out at the airport and tracked his flight across the Pacific and into Beijing at about 2 p.m. yesterday afternoon. This is an aircraft that is registered to Tesla, so we assume that he was on this particular aircraft, as you can see. And we do have actual evidence, as we just saw that soundbite from Elon Musk, as well as meeting with Li Qiang, the premier of China, who is also the former party boss in Shanghai when Tesla set up its most productive factory in the world in Shanghai in 2019. So they definitely have a relationship. And look, Tesla, as I've been reporting from the auto show that began last week and is concurrently running now in Beijing, they are losing some ground in this market to the upstart Chinese EV makers and also the tech players like Xiaomi. All the buzz at the Beijing Auto Show has been about these new smart EVs from Xiaomi and also other cars that are using Huawei technology, so-called Huawei Inside. So Tesla, which really had some good sales here in the early going, has been falling down the leaderboard in this market. They were not at the Beijing Auto Show. There was no booth for Tesla there. They had no new models to unveil. And obviously, based on the latest quarterly results, the first year-over-year decline in quarterly revenue since 2020. They're cutting headcount. They are looking to accelerate new models, but they simply just didn't have anything to unveil at a time when all these big and new upstarts here in the EV space in China were unveiling tech-heavy, gadget-heavy cars that got all the attention. So Elon Musk coming in here, looking potentially, what we're hearing from sources, to get approval eventually for its FSD system, that's full self-driving system that has a steady revenue chain in its developed markets like the United States. They charge essentially $8,000 to purchase outright for buyers of Tesla, as well as there's a $99 a month subscription. But there's all kinds of different regulatory, data security, and safety questions that would have to be resolved here in China to get it to be approved here in this market.
And Steve, you hit the nail on the head. Commercially, they're not doing as well as they have been in recent years. So what is the plan? How is Musk looking to address that problem? And how much better off are they after this trip in trying to address that?
Well, I think if he gets regulatory approval or some progress, and we're going to have a guest later this hour, I believe, who says that this could potentially be a game changer for the FSD system if China approves it and it can start going into some Chinese cars, obviously, that are sold here. But again, there's sensitivities over the cameras that are a part of this system. Obviously, the data that it collects on Chinese users. However, Tesla has complied with Chinese regulations as far as storing data in the Tesla cars that are used in China onshore in Shanghai since 2021 or so. Yes, 2021. But again, we also heard that according to the Chinese Administration of Automobile Manufacturers yesterday afternoon, coincidence or not, at the same time about that Elon Musk landed here at 2 o'clock yesterday afternoon, that administrator or that association announced that Tesla Model 3 and Model Y passed a data security reviews that were being conducted here. So again, he has good relations with Li Qiang. He has good relations with the Chinese government. He sees China as such a key market, but there's so many upstarts here that are kind of eating their lunch right now with no new models. And it shows the priority that Elon Musk puts in China. He canceled or postponed a trip to India where he was going to meet with Narendra Modi on the 21st and the 22nd of this month. There's all kinds of tax issues that he needs to overcome to get more Teslas into India, as well as SpaceX's Starlink in India. But he sees the priority right now, while the Beijing Auto Show is going on, to concentrate on this market.
Stephen Engel in Beijing for us, our Chief North Asia correspondent. And as Steve was just pointing out there, in about 30 minutes from now, we'll be joined by Dan Ives, of course, in case you don't know him. He's, of course, with Wedbush Securities. 10 Tesla bull, so to simply underscore that point, one of the highest price targets on the street on the specific stock. So we'll be talking about all things, of course, what happened over the weekend.
Yeah, he says this trip could be a watershed moment for Tesla. Let's switch gears now and talk a little bit more about what's been going on. Plenty of signs are pointing to a revival of Chinese stocks. And for more, let's bring in Bloomberg Sammy Cha. She joins us here in our studios. So we're seeing equities in China and Hong Kong, really stage a sudden revival. What do you think are some of the catalysts behind this surge?
That's right. We've been seeing the MSCI China Index rise about 20% from its January trough. The Chinese stocks are just rebounding from their multi-year lows in the recent months. We've been seeing that. When we look at the Seng Index, the situation is similar. We saw a 9% rise in a weekly performance last week, and that is actually the highest since 2011 amid the reopening hopes. So we're seeing how the Chinese and the Hong Kong equities are rising amid the whole reallocation of these funds from different global investors when they're looking at the low valuation in the region, especially when it comes to the Hong Kong stocks. There's that depreciation fears of the yuan, so some of the Chinese investors are reallocating their assets as well.
Okay, so let's try and push this forward. What sectors are you guys, as your team, tracking going into this week now?
Well, just like Steve said, we're watching the EV sector after the Elon Musk's unannounced trip to Beijing. Of course, some of the Chinese EV names, we're looking at BYD as it is reporting its earnings today, and we have been hearing that it could be, we'll be seeing some of the slumps perhaps for the first quarter results amid the whole fierce domestic price cuts and price war. And of course, we are also looking at property sector because there was a news over the weekend how the city of Chengdu is actually removing some of the home buying curbs, and that is going to be affecting the real estate markets in a better way. So we're looking at these sectors.
All right, getting us warmed up for the week. Sammy Cha there, our Asia stocks reporter, and all things to watch on this world-beating rally here in Hong Kong. Just ahead, it's a big earnings week for Chinese lenders, big earnings day to be more specific. A preview of that with DBS Bank later on in the hour.
But first, we have Nomura giving us their strategies for Japan as the yen speeds up here this morning. We're also counting down the open of trade in Shanghai, Shenzhen, and Hong Kong. Happy Monday. This is The China Show.
Welcome back. You're watching The China Show. So big week ahead, big earnings week. Oh yeah, we have the Fed decision too, coming out on Wednesday as well. So jobs data coming out of Japan. You have inflation out of China. That's tomorrow. Of course, it's a truncated week. I should also mention in mainland China. You have the March minutes coming through out of the BOJ, although that might be slightly dated given the fact that we had the April meeting, of course, out on Friday. And on the Fed note, it's jobs week in the U.S. that comes out, of course, come Friday. There we go.
Yeah, certainly there's a lot on tap, the Fed decision and what Jay Powell's really going to say here, just given this Fed repricing that's been quite rapid. And you take a look at this renminbi here right now. So we're seeing a 10th day where that fix is above 710, so 710.66 here this morning, and we're still seeing around a 726 handle for your offshore rate here as well. But yes, let's start off with, despite all that weakness in the currency, stocks are doing its own thing, right? Take a look at what's been going on with this MSCI rally that we're seeing in offshore Chinese stocks, right? So we're nearing that 20% threshold that was set back when that floor was made, maybe around mid-January or so. Let's bring in Gareth Nicholson, CIO and Head of Discretionary Portfolio Management at Nomura. I mean, it's a world-beating rally, it seems, right now, Gareth. What are you looking at in terms of the durability of it, and what's really driving these inflows now?
Well, yeah, Yvonne, you're 100% right. It's been a fantastic rally when you've seen quite a lot of uncertainty and pullbacks in, the star, the US, the darling, India, and even Japan. They've all pulled back, yet you've seen MSCI China really, really do well. For us, this has been from the beginning of the year. This has been the eye of the storm. China has been struggling fundamentally. There is a big storm still circling, but the eye of the storm has meant that both technicals and valuation has given a great opportunity. So 20% up. We think it's great. We think it's still got some legs to go in some of the sectors, particularly ones where the government is most supportive. But until fundamentals change, until you see a real shift in the fundamentals, it's not that perfect trade where you get fundamentals, valuation, and technicals.
Could you elaborate slightly more on that? So you mentioned some way to go.
Sure.
Is there a number you could attach to that, and maybe some sectors that you think might be in favor, Gareth?
So MSCI, what currently about? We see currently spots about 58. We see about 64 there. If we put exact numbers, what we're feeling at the moment is whilst you're having a pullback in India and Japan, we think both of those are still buys. We are seeing some flows move towards China, diversifying out of the overweights there. We think some of those will continue. The biggest driver for us is what your speaker was talking about a little bit earlier on, where it's the local money, the local fund houses allocating back into China. If you get China buying Chinese stocks, it becomes more sticky. That gives confidence to international investors, and that will continue to move forward. So it's flows continuing, which we like. Valuation is going to be compelling for some time. And then the fundamentals. You've got inflation out today. You've got more data out next week, which will give a bit more of a color of where the Chinese economy is moving. And then you've also got the great headlines where you have big international players coming to China looking to take advantage of this this region, which is still a high growth region globally.
So flows and technicals, you're saying, are kind of checking the boxes right now, Gareth. What about the macro side of things? Yes, we had that blowout number in the first quarter for GDP, but the March activity numbers are already showing signs of maybe even a slowdown. Is the macro picture going to get better to warrant this sort of rally?
Well, that's why we still think this is a tactical trade. We don't think the economy is out of the woods yet. We do feel that there is still quite a lot of uncertainty around how they're going to turn the property market around. There has been some news this weekend around lightening some of the measures. But as we know, the Chinese economy was too reliant on property. They tried to rebalance that. It has been rather painful. They need to find a happy medium somewhere. I think it's getting closer, but there's still a lot of uncertainty around that driver, property as a driver for the economy. And then if that's not the main driver, what's next? We haven't really seen that yet. So for us, this remains still a high conviction tactical trade where we're still looking at the rally, but we're being pretty selective about how much more upside yet. We're looking to cap the downside, looking at principal protected ways of playing this because it has been very fast on the back of only fundamentals, only technicals and valuation. Fundamentals hasn't really shifted yet.
Gareth, just to pivot to another equity story, which is the U.S. I mean, we're about halfway through Mag 7. We have 2 this week. I think NVIDIA's in a couple of weeks. Overall, how are you thinking about U.S. equity markets at all the metrics that you just laid out there?
Well, again, look at the same sort of thing. Fundamentals, valuation, technicals. Fundamentals, there's very few things you can point to in the U.S. economy that are weak at the moment. It's still a very, very strong economy. Technicals, flow still remains very high in U.S. and you see any signs of positive earnings that still goes in. It's just the valuation is tough. We've come off maybe 5%. Some names a little bit less, some a little bit more. But to get really into the space, we'd like to see a bit more pullback. This week you've got the 3As, you've got Amazon, you've got Apple, you've got AMD. That'll be interesting to see how they play through. We had Tesla and Meta, very mixed results and very mixed reactions from the market. I think the 3 big names this week will give us a bit more clarity of where it's at. This is also coming in at the same time you have Fed's Powell's speech. He's going to most likely come across pretty hawkish compared to, for instance, the BOJ, which was very dovish last week. And then you've got the employment numbers. So all of these things, unless the earnings are solid, it could get a little bit more volatile.
So how does this Fed repricing, right? We've gone from 6 cuts to maybe 1 being priced in this year. How does it change portfolio construction for you, Gareth? Is it more about making stocks more appealing than bonds? Does it make you force you to look a little bit more domestically in some markets as well?
Well, absolutely. So the domestic angle, the diversification out of U.S. exceptionalism, because they will be running higher for longer. I think that is a agreed consensus. So where do we see value still in the U.S.? We still see in some AI-driven sectors. We still see in some energy. We still see in certain sectors. But we want to diversify that overweight that's been building up in clients' portfolios over the last 3 to 5 years into more India, more Japan, and tactically more China, Korea, Taiwan. So there is a few different places to play that. We don't believe that there'll be a hike. For us, the labor market has to get a lot stronger now for us to see a hike. We believe that labor dictates how many more hikes or how many cuts. Inflation dictates how long they'll remain high. So given real wage decrease, we think that the Fed will remain at these high levels, but they won't go higher. And that's really the stability we need, is to see the Fed saying, OK, we're going to remain here for maybe the next couple of quarters. And then the market can start repricing that. And then it'll be a great opportunity again for U.S. equities.
Gareth, final question. Can't let you go without getting the Nomura take on dollar yen. Honestly, it's getting ridiculous. Look at some of these levels, really. Why haven't authorities stepped in more firmly? And if they do, what does that cost globally?
We do think that the BOJ is getting very close. It's not just dollar yen. If you look at some of the other crosses, it's moving to some very stretched levels. The BOJ was very dovish, obviously, on Friday. And now you've got the Fed, which is coming out, and it's going to put even more pressure on. So it really is becoming a very hot, I think, room in the BOJ and the finance minister's space. We do expect some intervention to come as we get closer to 160, but they are being very, very patient. So we're watching the level. Our view for the end of 2024 for the yen is 145. So it's still quite away from here, and we think that is still of a higher conviction. So we do expect the BOJ to step in as we get closer to the 160.
Gareth, a pleasure to have you on the show. Have a great week ahead. Gareth Nicholson, CIO, Head of Discretionary PM at Nomura. We'll leave you a look at futures going into the open 6 minutes away. You're watching The China Show.
All right, it's a big week for earnings, as we talked about here. Starting to see some pretty big price movements here when it comes to AIA. Look at that stock up some close to 8% here. The new business value soaring some 27%. They also added $2 billion to that buyback program, so certainly that's helped. Sinopec, though, that was no change there, but they did talk a little bit more about profit falling as costs and the economy outweigh that travel boom out there. And BYD, China Wanka, is set to report a little bit later on.
Yep, among the many companies reporting today, all of that considered, 0.5% to the upside on Hang Seng, building on the best week in 12 years. The open is next. This is Bloomberg.
Welcome back. You're watching The China Show. It is a Monday morning, of course, and we're kind of down to this world-beating rally and whether we can continue for another week or so. You take a look at how Hang Seng is doing. Looks like we're seeing some decent gains in the pre-market here right now after what we saw was the best weekly performance since late 2011. We talked about MSCI China getting close to that 20% threshold as well. HS Tech, we saw, I think, double-digit gains last week. HSCEI, biggest weekly gain since 2015. The superlatives are all positive right now, Dave.
Absolutely. And you know what? We've actually been here before. We've seen rallies of this extent from bottoms amidst the bear market. It feels different, though. That's based on what some people are telling us, given the additional sort of factors and conditions to consider. And you're really getting more regulatory reforms coming in and them really talking about how that's really encouraging some of the flows to come back in and finally take advantage of what's really a cheap market. And you know what? Guess what? Monday, we're up again here, 0.5%. A lot of this has to do with AIA, which is a very heavily weighted stock, which we'll talk about in just a moment here. But you know what? 18,000 might just be a potential reality. By the end of maybe this week. We're a couple of good days away from that specific level. Last time at 18,000, just for context, was back in November of last year. 10-year yields, as you can see on your screens, is a 30-year bond auction today. Just keep that in mind, CGB-wise as well. A couple of other things to track. We're looking at, we don't have property here. We'll have property in just a moment here as well. Some news coming out of Chengdu over the weekend, relaxing some of those restrictions coming through. It's a big earnings day, big earnings week. We'll talk about the banks in just a moment here. Change the page, please, if we can. Tencent, one of the big rallies last week here. DZ Bank upgrading that stock to buy. Premier Li Chang, actually based on reporting out of China National Radio, was actually visited the Beijing Auto Show on the weekend, visited the likes of Xiaomi, for example. We're up, down 10 to 1%, effectively talking about how China will prioritize developing that sector even further. Xpeng is up 4.8%. CICC, two pieces of news here. I think it was Reuters that came out with reports on investment banking salaries might be cut 25%. That's number one. Number two is the regulators actually issued a warning here for CICC. Well, maybe we'll get more on that in just a moment here. Not much reaction in the shares, in fact, going the opposite way. Earnings, we talked about that. Sinopec out in the weekend. You have AIA, which is really getting a big boost right now, 6%, came out a couple of hours back, and coming out today, BYD, and also, we haven't figured out how to pronounce this just yet. I'll go with Vanke. You could go with Vanke. But that's coming out with earnings, among the many other names, of course. Happy Monday.
I don't think we'll ever get to the bottom of that one.
No.
Yeah. But yes, it gives us a bit more options, I guess. Okay, as Dave mentioned, it's a busy, busy week for earnings. Not just what you're seeing in China, but in the U.S. as well. We're watching out for that Mag 7. Part of that really is the Amazon and Apple story this week. Here in the region, we'll also get data from Samsung results, I should say, Vanke and BYD. And the focus will also be on the China banks as well. Well, not just the lenders in China, but really the rest of Asia also. And you have the likes of ICBC, Bank of China, Agbank, and China Construction Bank, HSBC, and Stanchart also reporting as well.
Yep, let's talk about these banks coming out and the broader themes to track as we get into this earnings season. Joining us here on set is Manyi Lu, China and Hong Kong Banks Research Analyst at DBS Bank. Good morning and nice to see you.
Hey, good morning, David.
So what's the most important theme you think to track across these earnings?
I think the investors are looking closely at the NIM side, like the NIM pressure on China banks, and also the revenue growth and the provision changes. Because I think the market is expecting some revenue pressure on China banks, especially on the NII side and also the fee income side. Yeah. And so if the banks want to keep positive earnings growth, say I'm expecting like 0 to 2% earnings growth year on year for their first quarter result, then they may have to release some of their provisions to profit. So yeah, I think the investors should closely watch the asset quality indicators and also the NIM indicators to see the China banks' profit trend.
So even if there's a whole whitelist now, and banks are supposed to be extending credit to these developers, you still think provisions are going to have to be released? So a moderation of provisions just to help with profit growth, not actually an increase in provisions?
Yeah. Actually, we already see this trend in fourth quarter last year, and we already see the banks are cutting significantly their provisions to lower down the credit cost and to boost the earnings growth. And actually, I'm not too concerned on this point because China banks still have very high provisions, especially the SOE banks that usually have higher than 200% NPL coverage ratio, which gives them enough room to release their provisions to profit.
Okay, what about dividends? This is usually a dividend play for investors?
Yeah, I think they will, most of them, like the SOE banks, will continue to keep like at least 30% of the dividend payout ratio. I think that will be unchanged given that they still have quite high capital position to support the dividend growth. And I think they remain as very, very good dividend player, giving 6 to 10% dividend yield. Yep. Yeah, for FY24, even after the recent rallies.
I'm just wondering, just given what's happened with China Vanke or Vanke, I don't know how we say it, but this was previously seen as a strong developer, and the fact that they too are now caught in this sort of cash crisis, does that just spook these banks further from wanting to actually help these developers out there here? I mean, how does that change their psychology in any way? And what does that mean for loan growth?
Yeah, I think on the bank side, obviously, I think they are kind of very cautious to add their exposure to the developers. And we can see that from their balance sheet, we can see that they are de-risking from the China property sector, lowering their exposure, even though we are hearing some policy guidance asking them to support the developers. But looks like from the current situation, the banks are not forced to support the developers. So they still, they are choosing the borrowers according to their own risk appetite. So they are not really give a quite high support to the developers with liquidity problem. Yeah.
What about on the mortgage side? Have you seen demand for mortgages or mortgage credit picking up on the consumer side of things?
Not really. I think the mortgage demand remains quite weak, and there are still some early repayment of the mortgage, although it is kind of marginally being proven, but still we can see that there are some early repayment of the mortgage. And I think on the demand side, I think still kind of weak. So the loan growth this year, my expectation is that the retail side, including the mortgage and the consumption loan, may remain quite weak this year, and the earnings, the loan volume growth may still mainly come from the corporate side.
Okay. Your top picks still remain Bank of China, CITIC Bank. Long-term picks, you've added CCB. Can you walk us through some of these calls and why?
Okay. So I think our near-term top pick, BOC, that's mainly because, the China banks are facing with some NIM pressure due to the loosening monetary policy environment. Well, BOC is their exposure to overseas assets is the highest, 20% of their asset is overseas. So that can help them to partly offset the NIM pressure in China, especially before the U.S. interest rate cut. And for CITIC Bank, I think that's kind of a valuation call. It's even after its recent outperformance in share price, it's trading at a discount to peers, while I think its fundamentals is not bad, not worse than peers, and it's offering the highest dividend yield among the banks we cover, near 9 to 10%. So I think that's also an attractive valuation call. And for the longer run, I think the CCB is one of our topic among the big four, because we see also it's trading at the lower end among the big four at the valuation side, while it offers the highest ROE. And for CMB, China Merchants Bank, we are expecting it to catch up maybe in the long term, given it's still the best quality bank in China. Yeah.
All right, Manyi, we're going to leave it there, but thank you so much. Manyi Liu, China Hong Kong Bank's research analyst at DBS Bank. We're taking a look at yen. Oh, my goodness. You take a look at what's going on, and we are basically weakened past that 160 level against the dollar. This is the first time we've seen since 1990. So there's once again a fresh 34-year low for yen. We're just at 159.32 levels. Keep in mind, we just heard from Gareth Nicholson from Nomura, CIO there, saying, once we get the yen past 160, that could be that level where Japan could intervene. Which
complicates things, because in case some of you didn't know, Japan is actually on a holiday today. So not that it's not possible to hear any commentary coming out of Japanese officials on a holiday, but it certainly complicates the math in terms of the probabilities of whether or not they can, should, and will step into these levels. I'm just looking at my Bloomberg right now. December 25, 1986, we traded at 161.45. So we're hovering between those mid to late 80s to early 90s levels here on the exchange rate. So, we don't see this one.
It's interesting. Mark Cranfield from the MLive blog is saying, it could be an errant trade. I mean, obviously, because we're in a Tokyo holiday, maybe there's a fat finger explanation of all of this as well. But as we mentioned, given the fact that Japan is closed, liquidity is pretty short here right now. So maybe we're seeing these outsized moves as well. But there you go, 159.27 for dollar yen this morning. This is Bloomberg. All right, heading back to our top story here today, Elon Musk making that surprise visit to China. And our next guest is one of the most fervent Tesla bulls on the street out there, Dave.
Yeah, Dan Ives, of course, MD, senior equity analyst at Wedbush Securities. In fact, when you look at his price target, one of the highest on the street for Tesla, and he says, of course, this visit to China, unannounced one, could be a game changer. Joining us as well is Stephen Engel, our chief North Asia correspondent in Beijing, where, of course, Elon Musk's plane landed at the airport yesterday. You know what? Let me start with you, Dan. Just on the, what do you think? And let's get straight to it. By the way, what do you think Tesla is likely able to do now that it wasn't perception-wise last week?
Well, it's a watershed moment because Musk doesn't just make this trip just to do it. Because if this could open up FSD in China, which I view as unlocking what could be really the golden opportunity for them when it comes to FSD and autonomous in China, which has been a missing piece in the puzzle.
Well, Dan, Steve Engel here. Let me jump in and ask. You know, there's no doubt that Tesla needs China. You know, with Elon Musk making that surprise visit. But does China need FSD? I was at the auto show. I saw all these new range of EVs. I hadn't been back to the auto show in 4 years because of COVID, and the technology has rapidly improved here, where a lot of these technology companies, whether it's Xiaomi or Huawei or others, are into this space. I'm going to go later today in Daxian District and get a test drive of autonomous robo-taxis by Pony AI and Toyota. Does China need FSD from Tesla?
Well, look, I mean, Musk's most followed person probably in the world. And Tesla, I view as a trophy case for Beijing. And that's why Musk is there, because despite what we've seen in terms of just the massive competition domestically and so impressive from BYD and others, China needs Tesla just like Tesla needs China. And I think this is an important visit, especially in what I believe will be a rebound in China for Tesla. But FSD, that's the golden goose. That's what Musk is going after here.
Is there a risk to this relationship, though, between Tesla and China? Dan, I wonder, because just given the geopolitics right now, I'm guessing some of these DC hawks, China hawks, are not too thrilled with maybe what comes out of this trip as well. Could that be, you know, this relationship could be more vulnerable than we think?
Look, I think it's no different when Cooks visited China and others. I mean, it's all part of this 10% politician, 90% CEO, right? When you look at Musk, I'd say almost the same for Cook. But when you look at Tesla, it is massively important within China. And it's very important to have Musk, I think, a very important part of the EV environment within China. And I think that's something where this visit, the timing's important, because like you say, the geopolitical, it's a cold tech war, but China needs Musk. And that's why, and vice versa. And I think this is a huge positive that will be very viewed favorably by investors tomorrow.
Yeah, Dan, I want to get your thoughts
Dan,
on something that Steve brought up as well. Steve, go ahead. Sorry, go ahead, Steve.
No, that's okay. Go ahead, Dave.
Okay, let me take it then. So one of the things, Dan, that was brought up last week by not just one, a couple of guests, was it's not simply price that is a challenge for Tesla in China. To Steve's earlier point, the product lineup and the perception that a lot of the Chinese car makers have an offering that is either not just cheaper, but gives more value for Chinese consumers. That's the issue. And I'm wondering, Dan, whether or not you think it's a product offering issue as well in China for Tesla.
Look, I think Musk addressed that in the call. I mean, you will have what I view as a sub $30,000 vehicle by early next year. That comes not just globally, but we'll see in China. But just like we've seen with Apple, I mean, the Tesla brand is unique globally, and it's part of what Musk has built. And obviously, competition is going to continue to be fierce in China, but many consumers within China, they want to be driving a Tesla. And I think that's something where maybe a little blooms come off the rose, but there's a rebound that we see on the horizon within China. And that's why Beijing's courting Musk, just like Musk is courting China.
Dan, how much is the data security issue going to be a hurdle, if you will, for Tesla? I know they've been storing their data from Chinese Teslas in Shanghai since about 2021, complying with Chinese law. But again, it is a big issue geopolitically and commercial viability as well here in China. As well, the second part of that is the safety concerns. We all know that autopilot, there's a launch of an investigation in the U.S. about 20 accidents since December. Is FSD, the second part of this question, is FSD significantly, potentially safer than autopilot?
Yeah, look, and Stephen, you ask great questions, because I think for one, maybe a year ago it's not there, but now if you look at FSD 12 and you look at what they've done at Tesla, I think it's ready for prime time. In other words, I'd be surprised if China doesn't green light this technology, given where it's going. And then to some extent, like the security issues, look, a lot of the data will have to be kept in Shanghai, just like we've seen since 2021. But in terms of the algorithms and in terms of actual that data, it is important from a Tesla perspective that's something that can be used globally as part of their, you know, what I view as their unique technology ramp. And this is, look, it's a balancing act. But that's why Musk is there breaking bread to sort of navigate these challenges that I ultimately believe he'll be successful in.
So, I mean, you still have an outperform for the stock, Dan. 275 is the price target. We're hovering around 168 for the stock here right now. Beyond just the FSD stuff in China, what else needs to happen really to get to that target now, you think?
Yeah, look, demand, especially resurgence in the second half of the year. We know it's going to be tough in terms of, you know, coming into 2Q. I think numbers are set well in terms of now for the street. And I think investors are looking through this, because if you start to see a resurgence in U.S., Europe, especially in China, with FSD, the golden goose, this is a stock that starts to hit north of 200. I think that, in our opinion, that category 5 nightmare that we've seen, that storm for Tesla, a lot of that's in the rearview mirror.
Understood. Dan, just a quick thought there, since Yvonne brought up earnings as well, and, you know, whether the stock has bottomed. Have margins bottomed, or are there any early signs that margins are about to bottom? Because one of the guests told us last week, when that bottoms, the stock bottoms.
I think margins are in the processing of bottoming, and it goes back to the New York City cab drivers bearish on Tesla going into earnings. So I think we've navigated a lot of that, and now I think it's set up for a lot more positive surprise, and this is just one. FSD in China, if that gets unlocked, it would be a game changer for the stock.
All right, Dan, we're going to leave it there. Thank you so much. Wedbush Securities Managing Director and Senior Equity Analyst in New Jersey for us. Also want to thank our Chief North Asia Correspondent, Stephen Ingles, in Beijing. We got plenty more ahead. This is Bloomberg.
All right, welcome back. You're watching the China Show. We're looking at the currency markets very closely this Monday. For a brief, fleeting moment, the yen was trading above 160 on your screens, 160.17 thereabouts. Just looking at this chart, all that said, it's effectively academic, really. We're trading at a very weak level. It's at a record high as well on euro yen here.
Yeah, it's a holiday, which makes it tricky. So we're not sure if the Ministry of Finance is going to act, if at all. But it's interesting. You hear some commentary, the likes of Pepperstone's Chris Weston saying, you know, they have to act soon or risk facing a credibility crisis. You have Goldman Sachs saying intervention isn't sure to be a success, though, given the economic situation and Japan's lack of tools. So whether it's effective or not certainly is one thing. Whether they're going to do it or not is also another thing as well. But there you go. Even the yen crosses, you're continue to see that weakness across the board there. Yeah, there we go. I think Nomura came up through earlier on in our shows. Gareth Nicholson talking about how, and you know what, at that point in the conversation, 15 minutes back, the yen is at 158. He said at 160, that's probably the line to send. And 15 minutes later, we're back at these levels. And it's interesting, like you wonder if it's good or bad, right, to have a yen this week for Japan. And for them to actually have this policy, I think Deutsche Bank called it this policy of benign neglect on the currency. We heard that in the BOJ press conference from Ueda on Friday, basically saying it's not that important to their policy decisions. But also, Deutsche Bank was saying it's not causing an inflation problem. So, maybe it isn't that important for the central bank as well. And it's really overall pushing up the value of overseas assets for a lot of Japanese investors as well.
Yeah, it really is. I mean, you could still make that argument. I mean, certainly that it's not become as disruptive as typically what you'd see. What's astounding, to Yvonne's note there, it's actually halved in value over 12 years, right, for a major currency like this. Okay, so apart from that, we're looking at
HS Tech.
HS Tech, which has done tremendously well. I think we were up 10, 11% last week. We're up a further couple of points in the first 24 minutes of the session. And as you can see, some of these EV plays like XPeng, NIO, BYD. And I would imagine this is down to the fact that you had, of course, some approvals coming through out of the automobile industry. And also Premier Li Chang visited some of these booths at the Beijing Auto Show on the weekend.
So maybe it's more signs of that tailwind for the sector as well. I don't know if the Elon Musk effect has anything on, effect on these EV players as well. But certainly his trip has been really kind of overshadowing some of the Beijing Auto Show as well. Global macro movers looking like this here right now. You take a look at how equities are catching a bid here. It really is Taipei that is leading the charge here this morning. We're up about 1.7%. The dollar is stronger against the yen, of course, as we talked about in most Asia FX here today. And if we see more hawkish Fed commentary on Wednesday, we might see more of that reverberation across Asia FX here today as well. And bonds, for the most part, mixed, but overall yields ticking slightly higher. Welcome back to the China Show. Here's a look at the HSI about a half hour into the session here, and we are continuing this world-beating rally right now. We're seeing gains of about 0.7%. We talked about it's a big week for earnings, not just for the banks, but also the likes of BYD, China Vanke, just the latest to report a little bit later on today. But I think it's more than 240 companies on the MSCI China that are likely going to be setting up and releasing their results just this week alone. That's a third of basically that index. So certainly it's a big, big week. And it's coming at a time when there's all these sudden inflows into this market, right, Dave? When you talk about what's been going on, I think it was like southbound flows. More than $9.5 billion worth of Hong Kong stocks were bought by Chinese investors in April alone so far.
Yeah, and it's, we're almost entering May. And, we've only had one single day of outflows across the stock connect, or net selling across the stock connect from the start of February, since this market came out of the Chinese Lunar New Year. And as you can see, of course, Monday coming out of the weekend, it's a risk on tone across these markets. Just about every single market is up, as you can see. By the way, Japan is shut today, although futures are trading as well. We should be looking at yields on the down if we had cash trading and treasuries right now. 0.3%. I suspect that might be down to the fact that you are probably getting some bets coming through. That's going to be a good day for Tesla on the back of some news on the weekend there in China. 0.25% to the upside. Ex-Japan is 0.6%. Asia, by the way, we're coming off not just Hong Kong. Because of Hong Kong, Asia's coming off one of the best weeks so far of the year, if not the best week this year. We talked about earnings coming through. By the way, Japan 10-year yields, ignore that for now. Look at AIA, of course, came out earlier on. Big moves there. Bank of China is coming out today. BYD and also China Vanke set to report today. And as you can see, some upside coming through here ahead of these earnings results, which we'll talk about later on as well, because we did some research on Bloomberg Intelligence side, and they put a fantastic report, Yvonne, on the weekend, which we'll talk about later. We're really earnings story, it's still the U.S. that stands out. But I guess there are other things we can talk about at this point first.
Yeah, there certainly is. And dollar yen is certainly one thing, right? As we kissed 160 just a few minutes ago. Let's bring in our MLI strategist, Mary Nicola. Mary, it's crazy, right? I mean, I guess we thought that 160 was, not that far away, given what we've seen last week. But, the fact that, can we still see the Ministry of Finance sit in the sidelines at these current levels?
you know, the problem is it's just such a predicament for the Ministry of Finance into when to intervene. So Friday you had PCE numbers. This week you've got the Fed. And if they come in and they do something and then the Fed unwinds everything they've just done, it's a tough position to be in right now. So it's hard for them to actually intervene and realize if their efforts are proved to be to actually do something, if there's still the Fed as a threat. So last time when they intervened, you did see that there was a drop in yields, in U.S. Treasury yields. But the fact is that there's still a risk looming with the Fed expected to double down on its hawkish rhetoric.
Is there, Mary, if we look purely at Japan, I know that it's almost impossible to look at things in a vacuum, but is there actually a case to intervene?
There, in terms of levels, of course there is, and especially because a lot of people onshore are getting, especially importers. There's concerns about how weak the yen is. There's also concerns in terms of imported inflation. Obviously, there's inflation that is coming through, and we've seen it in some of the CPI numbers over the past few months. So there is reason to intervene because of the impact of the weak yen on the economy. However, it's just, if you look at it, you can't look at it in isolation, and you can't look at it from just one perspective from Japan, because you have to include what's driving the weakness in the yen, and that has a lot to do with the Fed and the change in Fed expectations.
Yeah, what should we be focused on more this week? Is it more about what the Fed and Jay Powell is going to say in his presser, or is it really going to be about U.S. earnings once again?
I think it's going to be a combination of the two. So especially because the Fed is going to focus on, the Fed's going to be clear about doubling down on its hawkish rhetoric. We've already seen what PCE has told us, that inflation is still a problem, that it's lingering a lot longer than expected. But then if we want that equity rally to resume, you need to see that fundamentals are being supportive. So you don't have the Fed in the background to support this equity rally. It needs to sustain itself, and that's all going to come from fundamentals, from earnings, from the outlooks from these companies to really drive that rally.
Mary Nicola, our MLife strategist in Singapore for us, thank you so much. In fact, just on that very note, that very point that Mary just sort of underscored there, it's really about the fundamental story, because you're not getting that rate support just yet. Our analysts at Bloomberg Intelligence put out this new report on Sunday. And effectively what they're saying is, when you look at the data, the U.S. market leads first quarter earnings growth in every single sector globally, with the exception of financials and tech. U.S. large caps, as you can see on your screens here, are delivering growth of over 17%. Now, that's based on data, on both reported data and also consensus estimates, based on Bloomberg Intelligence Global Bellwether Index. That's 128, effectively, of the world's largest stocks out there. So it's still a U.S. earnings story on aggregate. Now, when you look sector-specific, in each specific market, including, of course, DMX, US, and EM, for example, in the US, it's communication services that's actually delivering and impressing the most there, with over 70% earnings growth. When you look at this specific market, the standout sector there is consumer discretionary, where you are getting about 16% earnings growth. That's first quarter, by the way, year on year, if you're curious. And across EM, of course, we mentioned financials. Financials and tech are the only sectors where the U.S. is not leading, because that's because of what's happening in EM there. Standouts are 11 and 38% respectively, enough to lead growth globally. And bottom line, though, going back to the initial thesis and premise here, is that while earnings multiples are lofty in the U.S., to Mary's earlier point, that actually may be justified and warranted because of the earnings growth we are, Yvonne, seeing in that specific market.
And as Mary mentioned, right, that if we see the fundamentals are still strong, that could still overshadow some of the Fed and what the hawkish, talk that could come out this week as well. Great stuff. Coming up, we're going to do a deep dive into China's clean tech sector and speak exclusively with the GCL Technology. This is one of the largest producers of a key solar material. Next, this is Bloomberg.
Welcome back. You're watching The China Show. Here are some stories that we're watching this morning, and particularly as this heat wave, hits Southeast Asia. Let's start things off in the Philippines here. So, well, the country is stopping in-person classes at public schools for the next 2 days. That's after temperatures in Manila on Saturday soared to 39 degrees Celsius. That's according, of course, to local media. That actually beats the previous all-time high recorded back, get this, almost, well, over 100 years ago. Now, the UN's Children's Fund says over 243 million children across East Asia and the Pacific are at risk of heat-related illnesses and death this summer. Now, it's a similar sweltering situation over in Thailand with power usage surging to a record. That's also on Saturday. Northern and northeastern regions are the hottest in the country, with some places recording a high of 44 degrees Celsius. And yesterday, at least 30 deaths in Thailand so far this year have been heat-related, compared to 39 across the whole of last year.
Yes, and I was in Vietnam over the weekend, and it was hot, to say the least here. Yes, and maybe more the need to talk about clean energy here today as well. And really, what is it, right? It's about using the latest technological advances to address climate change. And among the countries, China is the clear leader in the production of clean tech. You think about all these sort of materials that we're talking about here, right? Data from the end of 2023 show that China had a share of at least 80% in 11 out of the 14 sectors key to renewable technology. So everything from hydrogen electrolyzer to solar modules. And these are tracked by our team at Bloomberg NEF. And it's the production of certain components for lithium-ion batteries. China's share is north of 90%. And its lead is the smallest in the production of nacelles here. You take a look at wind turbine nacelles. That's where you're actually seeing the smallest share, the central hubs of these wind turbines. So its share in that segment is north of about 60% or so. But still, it makes the majority. China managed this by outspending everyone else in the world, right? Last year, global investment in factories for clean tech components reached $119 billion. 92% of that money was spent in China. Bloomberg NEF says recent Western onshoring policies have yet to make themselves felt. Particularly what you're seeing in Europe and U.S. Production capacity has either plateaued or shrank last year, although that was expected due to some of these long lead times, Dave.
Yeah, let's get more on this topic and really dig even deeper with Dan Murtaugh. He's in Beijing for us, our Asia energy reporter. Dan, just walk us through just the challenges that remain in front of us as far as the sector is concerned.
Yeah, David, the Chinese solar sector has just gone through a massive period of capacity buildup, which, frankly, is necessary for the world to meet all of the clean energy and energy transition objectives we're trying to. In fact, you could argue that the only sector in the world that's doing its job right now is the Chinese solar sector. But because of that, it is put way too much capacity on the market than demand can handle right now. And so you're seeing prices for materials all through the supply chain plummet, and companies are responding. Some have announced layoffs, some have announced plans to reduce production or to halt or limit expansion within China. And at the same time, solar is finding itself in the strange position of being in the political crosshairs, as many governments in places like the U.S., Europe, and even India are looking to build up their own supply chains and sort of focusing trade and geopolitical issues on China's solar sector. We have with us in the studio today Amy Song, a Vice President at GCL Technology, one of the world's leading polysilicon makers, a key component in solar panels. Amy, what is GCL doing to survive and cope with this current down cycle, and when do you guys see the industry starting to swing up again?
Well, thank you, Dave, Dan, having me today. I want to talk about our company strategy first. Obviously, it is painful in the near term to see a substantial overcapacity in the industry. But on the beyond that, we're seeing this. This is the fourth time that I'm observed in this industry. Every time after supply-demand balance itself, we see a better technology, better company to be survived in this cycle. And we are fully anticipate that, because GCL has been a long-term player in the polysilicon segment. So this time, we fully anticipate in terms of a better balance sheet. We have a net gearing around 15%. So cash is the king. And definitely, we manage it very careful on our cash. And then also, we look into more opportunity in overseas market while we carefully and smartly using our money. And on the other hand, obviously, you got to have a competitive edge, which means you got to have a best technology in the industry. You got to have lowest cost structure, and also you got to have the largest operating scale. So right now we have a total capacity of 420,000 metric ton. If this capacity being fully produced this year, it counts roughly 25% global market share. And also, we are the lowest producer in the polysilicon segment. So with our current FBR technology, we're using less 80% of energy consumption versus conventional silicon roll poly. It enables us to steeper the cash cost curve of the polysilicon industries. Therefore, we be able to fully commit to our output with our key customers. So
thanks. I mean, you talk about technology, and when I talk to the executives in the solar industry chain, they acknowledge that the overcapacity problem is there, but this is an industry where technology changes so fast that if you're not investing in new factories, your facilities can be obsolete in just a couple of years. So what is tell us a little bit more about fluidized bed reactor and how you guys have developed that technology over the past few years to get it to the point where it has these advantages that you mentioned.
Sure. If you look at the solar value chain from poly to module, I would say polysilicon has the highest entry barrier in terms of technology and capital intensive. So usually in new technology, in investing in polysilicon, it may take a decade to be commercialized. That's exactly what we do in the FBR technology. So we are the first one in China to develop the traditional Siemens cold generation, power generation technology for the polysilicon and bring down the electricity consumption from 150 kilowatt hour per kilogram to 50. Whew. Yeah. So that was happening in between, I would say, at the first decades when company was developed. But in the last decade, we invested heavily in the FBR technology and by own pioneer research team. And also, remarkably, in 2017, we acquired a U.S. company called Seng Index, along with their R&D team, their IP, and also their technology in FBR. We merged these two teams together. We will be able to materialize the FBR production in China in a massive scale. So our market share was only 10% at the beginning of last year. Now we are reaching to 25%. Amazing. Even in a down cycle. Recently, we just announced a 3-year long-term contract with our number one customer with over 400,000 metric ton of poly offtake contract.
Fantastic.
So, yeah.
And now, as we look forward, how long do you guys expect it for the market to digest this overcapacity that it's facing and sort of get back on an upswing again where supply and demand begin to match? And how do you think it will happen? Is it that obsolete technology will have to shut down and go away, or demand will rise to meet the capacity that's here, or a little bit of both?
Yeah. I would say a little bit of both in a short term. Supply-demand will balance itself, but it's a painful process when the high cost structure player, smaller scale player get pushed out of the system. And also, over the time, the liquidity in terms of financial support from the capital market or from their own cash generating capability have been slowed down. That's why they've been forcing out. So on the other hand, when pricing of module price continue coming down, we will see a more and more solar demand worldwide. That actually happened very, very clear in the past cycle because I remember in 2018 and around that time, we ran into another short-term down cycle, but real parity has arrived globally. It's make the cycle different because in the previous two cycles, which was happening in the financial crisis in 2009, in 2012, we see a demand in terms of market is driven by feed-in tariff. So it's not real demand; it's driven by the policy.
Subsidies.
Yes, subsidy. So, but starting from the last down cycle, we see the demand actually coming down. The falling price driven more demand globally, but the demand responds slower to the module price falling. So that's why you're seeing probably it's very hard to forecast solar market in a short term because it's a global demand, and every country they have their own energy policy. And the further you go in terms of downstream EPC, the more of a self-market protection mechanism being placed in place. That's why you see a lot of geopolitical risk and talking right now. So that happens quite always like that every time in terms of down cycle, boom bust cycle. So I would expect that the demand will get balanced over the time. But I would say come back to the polysilicon segment. This is the segment probably in the near term, in the next year or two, will be balanced sooner than any segment, like a wafer, cell, module, because this segment has a higher exiting barrier, which means once you've been forced out, it's hard for you coming back, because either need a lump sum of cash to clean up the current existing capacity. All those existing is sitting on the ground. You got to clean up, replace new capacity. So that's why this segment is getting much easier. Yes.
Yeah, Amy, sorry, I just wanted to pick up on that point you just made there. David here, by the way, in Hong Kong. I'm wondering, this down cycle and the price wars and the overcapacity you just outlined taking place right now, do you think that comes... Do you think future innovation suffers? In other words, R&D budgets are starting to suffer because of what's taking place, and we might pay the price in the future in terms of just the technology available to us.
I don't think investing in technology will be suffered, but in the short term, you probably don't see the impact immediately. Especially come back to the polysilicon segment, it takes 10 years for a new technology to be materialized and commercialized. But speak for cell module, maybe P-type shifting N-type, it takes shorter time. But it's more of learning from each other process rather than innovation. So if you look at FBR technology, we are the only one in the world can do that in that scale. Maybe there are one of two smaller players in the world that was only much smaller, a fraction of capacity they have versus what we have. Excellent. So that's like you make a 1 car versus make 100 cars. That's so different. It's a different story. Yeah.
Thank you so much, Amy. We really appreciate your time with us today.
Yeah, thank you, Dan.
Back to you, Yvonne.
All right, Dan, great stuff. Thanks so much for leading that. Dan Murtaugh there from Bloomberg. Also want to thank Amy Song, GCL Technologies Vice President. If you are a Bloomberg subscriber, you can catch up with all of our interviews by using our interactive function, TV Go. You can join the conversation, send instant messages to our team and our guests during our live shows. Check it out at TV Go. Right, bit of a throwback right now with the Hang Seng Index 1.2% at 17,861. We're back to levels at the start of the year, so we've reversed year-to-date losses. And what's the thing they say? Onward and upward? Question mark. This is Bloomberg. All right. This rally continues for another day, and we're seeing a strong one at that. Hang Seng up more than 1%. Same with HS Tech here now. And we talked about basically the Hang Seng basically has erased all the losses of this year. So we're actually seeing gains now for 2024. What's driving that? There you go. Your China Developers Index is up some 8.5%. It's the best day that we've seen in 5 months. What's driving these property stocks? Several things. So everything from Chengdu relaxing some of their curbs here when it comes to home buying rules to revive sales. You have the likes of Sifi Holdings also talking about a holistic proposal for its offshore liquidity situation with ad hoc group of bondholders, and also China Wanko reports a little bit later on today as well. So property is hot right now. Very hot. There we go. 8% to the upside. So there's that pocket of the equity market. And on top of that, there's also what's taking place in EVs, right? With the news of Elon Musk and Premier Li Qiang visiting some of these companies at the Beijing Auto Show, reiterating the government's support for the sector. And you're getting not as much as you're seeing on your screens on property, but still substantial gains. And given the weighting of these stocks in those benchmarks, BYD's up 2.7%, CATL and Gangfeng Lit up 4%, you're going to get a broad-based rally. In fact, it's not just Hong Kong today. As we were showing earlier on, CSI 300 is up 3 days into today. We're up 4 days in a row, and we're up 1% on that benchmark about an hour into the Monday session. Broadly speaking, though, the markets are looking like this. It's generally a risk-on session. Japan is shut today. Just keeping in mind to no cash treasuries, no cash equities in Japan. Futures are trading.
And it's a big week. You have everything from the Fed to the U.S. jobs, plus other things, of course, on deck.
Yeah, and earnings like from Amazon, Apple, the like here. So certainly you have a mix of everything. And we're still watching what goes on with dollar-yen, right? So after briefly hitting 160, we're back off that slightly. But certainly we're watching very closely what comes through from the Ministry of Finance the next couple of days or so, or a couple hours or so, even if they are working on this holiday. But there you go. You can take a look at Chinese 10-year yields are also up some 5 basis points right now. Wow. So you're seeing that sell-off come through the bond market and really flowing back into stocks here this morning. CSI 300 also up some 1% or more. We got plenty more ahead. This is Bloomberg. Welcome back to the China Show. It is a pretty decent day if you really like to buy these equities here this morning. Take a look when it comes to Asia ex Japan, right? We're up 0.8%. We're basically building on the best week of the year for Asian equities. If you break it down, it's really what's going on in Hong Kong and China here. We talk about the Hang Seng basically erasing all the year-to-date losses already after what has been a stunning rally and really top class, right? The world's best market last week, basically here as well. So we're continuing on that here today, it seems. Sector by sector, seems like it's a bit mixed here, but tech certainly is catching a slight bid. And we're watching very closely what goes on with dollar-yen this morning as well. The dollar is pretty much flat, but yen briefly touching 160 certainly is sort of the highlight of the day so far. Yeah, I was there for a couple of good seconds before pulling back, and it's complicating matters, of course, as Yvonne was pointing out earlier, that Japan is on holiday today. So does that completely remove, and not that they're saying there was a big probability of it, does it completely remove the possibility of any intervention today? Not just dollar-yen, euro-yen's at the highest on record. The Swiss franc against the yen is back to the highest level since 1971. So the yen is reaching fairly extreme levels here. All that being said, it's a very busy week ahead. So you have inflation coming through. PMI is coming through out of China tomorrow. It's a big week in the U.S. We have jobs data. And, of course, the Fed, where current pricing suggests it's either November or December as far as that first cut is concerned. So we've gone from about 6 to 7 to 1 or 2 at best. And certainly amongst all of these things, Yvonne, certainly this Fed meeting is going to be closely watched, particularly because of this massive swing in expectations we've gone through over the last, 4 months? Yeah, I mean, it's interesting, this big take. Our teams have been talking about this, crunching the numbers. They've been looking through all the 60,000 headlines to really see where this hawkish pivot, where are we right now? Has it just begun? They say yes, because if you look at just the indices that they've been tracking and basically, since that December pivot from Powell saying that we're considering rate cuts, it's basically, loosened financial conditions, it's released this whole kind of equity rally. And in some ways, what we've seen the past few weeks of a bit of a U-turn from officials as well as Jay Powell himself is only a fraction of really reversing some of the dovishness that we heard back then. So maybe this week and maybe the next few meetings, you're going to continue to hear more of that hawkish Fed speak here to try to at least reverse what we saw since December. Yeah, offset some of the big moves from that point in time. One of the measures, in fact, that we look at this is what you see on your screens is the Fed Sentiment Index, which effectively is, and you have a fairly clear delineation how hawkish we were, how dovish we suddenly became in December. That dip you see towards the bottom part of your screens, and maybe we're, to Yvonne's point, just the beginning really of us picking back up, if that's the course. Because there's so many theories of why the economy is still so resilient, right? They think, well, there's one very provocative one is that maybe interest rates are actually helping growth versus putting a drag on it. Yeah, that came up last week. That's interesting. The second comes out with maybe we just have to deal with a higher neutral rate on the U.S., and that's why we still need to see more hikes or at least hold at these levels. Or maybe it's the one about this dovish pivot, that maybe this was put too soon, that really led to the economy to continue to be so strong. Yeah. And that's what BE is leaning towards, at least for now. The third argument. One. Okay, yeah. that he went too soon on the pivot. Yeah. Okay, it's too early in the week to talk about R squared, higher neutral. So I'm leaning also towards the third. It's easier to understand. Let's put all this together for you. And that's taking place amidst, by the way, equity markets that dipped last couple of weeks, but really had a very good week last week. China. And U.S. markets, of course, through the thick of earnings season. Adrian Zuercher is with us here on set, CIO, Head of Global Asset Allocation, UBS Global Wealth Management. Let's start with the macro, if you don't mind. Do equity markets need
rate cuts to do well and continue to provide value for investors?
I would say for now not. Eventually, yes, they do. I think there's a risk, of course, if rates are staying too strong, and particularly inflation stays too strong, and we suddenly start to talk about rate hikes, which is, of course, not our base case. That would be a challenge for equities, where valuation is, where markets are trading currently. But for now, I would see that equities actually have very good run, and they also could, from here, see another 5-10% higher. We see very strong earnings growth. Yes, the market start to differentiate, looking at if companies are really delivering, but those that are delivering still getting rewarded. And more importantly, the earnings growth really starts to broaden out. So we see this, the UK suddenly is very strong, 5-year high. We see China actually coming back. So other sectors which have lagged, they also start to benefit. And I think that's probably the most important part for the next leg of the rally. We need a broader rally.
This Fed repricing, though, I'm just wondering, just given what we've been seeing across FX here, are we likely to see more reverberations and more volatility, just given the fact that, have we reached that reasonable level of where, rate cuts should be, or at least what people are pricing in right now?
Well, I think we always forecasted 3 rate cuts. We're now reduced to 2. I think the market got really carried away in December, starting to price in 6 or 7 rate cuts. I think now we're probably more in line where the macroeconomic strength is. Now, we also should not forget that the inflation numbers that we have seen that surprised so much of the upside was really carried by 2 or 3, I would say, idiosyncratic components like car insurance, hospital services. Overall, we actually see that more than 60% of the inflation components are now below 3%. Historically, that was around 70 to 80%. So we're not too far away, and that's actually the highest number that we have seen for the past 3 years. I still think that inflation is drifting towards that. We will start to see pricing in of more rate cuts in the year. Probably, we still expect the first one to happen in September. Maybe it's November or December. But then it's probably a series of cuts that are coming through, and that probably will push markets even higher.
I want to get to the equity calls in just a moment, but since we're talking central banks, what are you telling your clients, and as far as fixed income exposure at this point?
We still like the asset class. Yields are high. We see easily to make high single-digit, if not double-digit returns over the next 12 months. We do think that the strength we see in the macro side starts to fizzle a bit. We see the GDP numbers, which might have been a bit biased and a bit on the low side, but we can see that growth is coming off. Okay. And we do expect that some of these inflation numbers, these idiosyncratic factors, will start to diminish, particularly like car insurance, and that should give room for the Fed to start to cut interest rates. And the market has priced the opposite now, so I think there's room basically to repricing some of the cuts and some of the dovishness that might come through.
Now, on stocks, it's fund managers have benefited from being underweight China. Should they rethink that now, given the outperformance last week?
I do think what we have seen, it was a very easy macro trade, particularly for hedge funds. You're long US tech, you're short China or China tech, maybe you're long Japan as well, and that has worked very well. So you didn't even have to do a lot of research and stock picking. I think that has changed, but on both sides. We also see in the US side, if the company doesn't deliver the numbers or is a bit cautious on the outlook, they're selling off. And I think it's exactly this granular part where people have to do research and start to look which companies can actually do well, which have earnings growth. That is a benefit for China because it's so cheap, nobody's positioned, and they have to come back. And I think this rally can last a bit longer. I don't think it's driven by macro. It's really driven by idiosyncratic factors of the company itself on earnings. Macro, unfortunately, still remains very weak.
You just came back from Beijing. I mean, what were some of the takeaways, impressions that you got, clients that you spoke to? Overall, what's happening on the ground now?
It was very interesting. So the airport clearly more busy than my last visit. On the financial street and district, I didn't see a lot of Westerners. Also in all the meetings, I was the only Westerners meeting policymakers. On the other hand, it was a clear shift in terms, particularly from the academics that sort of advising the government to really go on to QE. Talking about the impossible trinity, forget the currency, slash interest rates to zero, do stimulus through buybacks on bonds, which is a clear shift to last year. So I think that will trickle up. That needs some time. It will trickle up through the government. And I mean, we look just at real estate numbers for April. So we think we're down more than 40% year on year still. So it remains very weak. They have to do something. It's good that the academics are moving in this direction. And I think eventually government will have to do more.
Silently, that almost seems somewhat what's happening. Bond yields can't seem to find a floor. The currency's trading at 727. And I'm wondering, do you think there's they're receptive to that idea? I mean, that's an extreme idea, but is the solution something closer to that?
So the feedback was that the government still doesn't listen too much to them. So there was skepticism there, but I do think that the acknowledgement that the economy still needs more stimulus, that the currency decline might be not the worst thing for China at this point, given there's very little external debt, for example. I think that is coming through, and that's starting to be reflected also in what we see in the market.
Okay. Just broadly speaking, we talked about asset allocation. I mean, 60-40 basically didn't do too well so far this year. What is the sort of right sort of allocation now if you look at multi-asset?
Well, we are fairly neutral on equities, close to the strategic level, but we are playing a bit more upside through option strategy. So we're buying option strategy, in particular on the U.S. side. So we're playing the upside on the U.S. side. And we extended duration. So we actually do think that duration is quite attractive. And we can't say it's a consensus trade anymore. That's a good part. So it might be even an anti-consensus trade, but we're buying duration at this point. We have a fairly strong view that bond yields have to come down over the course of the next 6 to 9 months, and I will give you sort of the extra boost for a 60-40 portfolio.
What about hedge funds or alternatives?
It's always a very good strategy to have hedge funds, of course, in portfolio, diversify.
Which types of hedge funds?
Well, long-short equities, for example, markets that basically are still volatile. We probably need hedge fund exposure, which are less directional, and that's how we will play that. So fairly market-neutral strategies.
Adrian, thanks for kicking off the week with us. Adrian Zuercher, CIO and Head Global Asset Allocation at UBS Global Wealth Management. We got plenty more ahead. This is Bloomberg. All right, we reached another milestone here. Take a look at what the Hang Seng's doing here right now. So basically, if we continue on this way to the end of the close here today, or to the close, we're going to be entering into a bull market, basically. So we're basically up 20% from the low that we saw back in January. And really, we can continue to see this market be top-notch. Really, what's driving it could be everything from these inflows, and what we're seeing is southbound flows in particular, which really we haven't seen a down day for weeks now, really, Dave. And earnings, certainly, we'll see if that solidifies this rally in any way this week.
We have a couple to latch on to today, right? So everything from BYD, a couple of banks, China, Vanke. I've been tossing back and forth in my head how to pronounce it, which is really not important given the greater scheme. We waited long enough for a headline of a bull market like this.
It's interesting when you talk to people about what's driving it, right? It seems like it's not so much the macro picture that seems to be a bit foggy still. It's not about fundamentals. It's really about technicals and flows, right? And even I think it was Nomura that was saying that they're not seeing that much short covering this time around in this rally as well. So maybe that suggests those two factors alone you can still chase it for a little bit. But I think Nomura still thinks this is still a tactical sort of opportunity.
Yeah, we're 58. They think this 59 rather. We think that we get to 64 on this specific MSCI China index. More on the earnings story coming through, and do we get the fundamental follow through across this market right now? So Bloomberg Intelligence says China Vanke first quarter results are out later today are likely to reflect increasingly tight cash coverage of short-term debts. Loretta Chen is with us here, our bond and loan reporter, to give us a preview of what to watch, of course, when these results come. What specifically to keep an eye out for?
Well, the first thing is obviously the sales, and Bloomberg Intelligence has estimated around 30% drop for Vanke in April compared to a year ago. And that's just continuing the kind of slump we're seeing this year with no signs of recovery. And that's really across the board in the property industry. You're actually seeing a narrowing of gap between the SOE sales and the private developer sales. So the SOE sometimes are experiencing a 40%, 50% year-on-year year-on-year drop in the first quarter compared to the broader industry. That's not something we've seen last year. So it's telling us that the situation is only getting worse. And on the other hand, we think that Vanke's profit margin may continue to be compressed because it may be under pressure to cut prices in order to boost these sales. On the other hand, the company is considering asset disposals. There's been news that it's trying to sell a stake in a logistic companies that could, get back around $2.5 billion. So that's a major development that we're watching there.
And of course, whether they address, this Moody's downgrade last week, we actually did hear from the company in a rare response, really firing back. What did they say?
They're not happy.
Yeah, they're not happy with the downgrade, obviously, and they're saying that they've got the support of its SOE shareholder, the Shenzhen Metro. But interestingly enough, when you look at the financials of Shenzhen Metro, it's actually got a worse liquidity profile than Vanke. So, investors will say, show me the money. If Vanke actually has that support from its parent, from its shareholder, then, where is the actual funding support? It's not just, just in terms of verbal support. The Shenzhen Metro has 0.6 in terms of cash to short-term debt, and that's actually not a very good metric. And we would wonder, where it will get all these cash to actually give to Vanke.
All right. Despite all that, we're seeing the stock up some 14% here right now when it comes to China. Vanke there. Loretta Chen, thank you. Our bond and loan reporter joining us on what to expect out of those earnings a little bit later on. And it's not just Vanke. Sorry, I keep saying different ways of saying it. Wonka. There's also other companies reporting earnings this week. We talked about BYD, China Eastern, see some of these airlines as well, Yum China. Banks like ICBC, Bank of China, all set to release earnings as well. We got plenty more ahead. This is Bloomberg. All right, here's our China brief here this morning. A look at some of the headlines that are making some of these national newspapers. And of course, it is Elon Musk's impromptu visit that Chinese media are focusing on. The Global Times covering it from a geopolitical lens and saying that despite claims of overcapacity by U.S. officials, companies like Tesla remain eager to explore the Chinese market. Analysts they spoke with say Musk's visit also highlights the importance of the Chinese market to many U.S. firms. This article on Xinhua also quoting Premier Li Qiang as saying China's market will always be open to foreign businesses. He also noted that foreign firms are, quote, indispensable participants and contributors to China's development. And I think it just goes to show not only did Elon Musk need this trip, I think China needed this trip from Tesla as well.
Yeah, the stars came together really for that conversation to take place. And we were talking about one part that perhaps was overshadowed by this trip, but was actually related to that, right? And you're seeing that in the markets today. There's, the Beijing Auto Show, all the technology that was on full display there. And Steve was there covering this for us, right? And he said there was no Tesla booth at all because they have nothing to offer, at least nothing new so far to offer. But yeah, it's a good time for the industry to come together. Li Qiang, of course, visited many of those booths.
Yeah, that's why EVs are doing so well today. But yes, I think the fact that, there was talk about the data security stuff, FSD. Dan Ives and Wedbush is basically saying, I think we're one step closer to bringing FSD to China. That could be something that could lift a huge overhang for the stock of Tesla. Of course, he's a fervent Tesla bull. But certainly, this is one of the big stories of here today. And the surprise, how, we were even tracking his plane, our good old Danny Lee, from the skies as well. In financial media, the Shanghai Securities News is saying that a number of Chinese cross-border funds have added Hong Kong stocks to their portfolio, and that's while reducing their U.S. equity allocations for the first 3 months of this year. Then you have this China Securities Journal saying the number of Chinese firms listing overseas is picking up. 20 companies have listed on the U.S. market this year, according to them, exceeding last year's number. And the report does say 12 firms have also listed in Hong Kong as the institutional environment continues to improve.
Well, China has pledged along these lines to encourage leading firms to list and also list here in Hong Kong, to be more specific. But that plan is actually facing some major challenges. Let's bring in Felipe Pacheco, our equity capital markets reporter, joins us right now. What are deal makers saying about this specifically?
Well, David, I think it's very interesting to hear that of course, it's always good to see that there's support coming from Beijing, especially after the 2 years of different crackdowns over several industries that we've seen. So it's positive, yes, very positive. It's clear indication that there is support for Hong Kong. Hong Kong really needs this support when it comes to equity capital markets, IPOs majorly. But then when you talk to those bankers, to those advisors, lawyers, consultants that are closely in touch with the companies and looking at the market as well, they are saying that this is not going to be easy. There is a very, very bad market out there. If we look at numbers, for example, the first quarter of 2024, IPO proceeds in Hong Kong were at the lowest level since 2009. It's very hard to find a company that's willing to come to market at such valuation. There is very little appetite for new names, and when those new names come to market, they don't do well. We had last week 3 IPOs that started trading. One of them fell close to 40% in the first day, and the biggest IPO this year, Chabaida, we spoke about it several times here during the show last week, it closed down near 30%.
Wow.
So when you have deals coming to market, there is not a very good welcoming scenario there.
I'm looking at Chabaida now. It's down another 5% despite everything else doing very, very well here today. So it doesn't bode too much confidence. Okay, what are we expecting then? Any big listings in the pipeline in Hong Kong then?
Unfortunately, not yet, Yvonne. It's like what we hear from bankers is they are in touch with the companies. There are several names that could be coming to market from different industries. We're not restricted to, for example, tech IPOs. They used to be the big hits for Hong Kong in the past and took a major hit since Didi's crackdown in the US back then. But what we need to see is actually a stable and actually positive market in the secondary market for a while, maybe for a few months. And then after that, you also need to see smaller listings doing well. You need to see a market that is welcoming to those new names in order for you to actually build momentum and also have a much better environment for Chinese listings as a whole, not just in Hong Kong, but for example, in the US as well. If you build this scenario that allows companies, big names to come to market, bankers say that, yes, there could be appetite. Is it in the near term? Not in the near term. Maybe short, mid to longer term towards the end of the year, for example.
Yeah, I mean, it's going to take a while for this market to turn. Felipe, thank you so much. Felipe Pacheco there on a specific report here. Back to markets, and maybe part and parcel to what we were just pointing out. There's signs that, things are improving, coming off lows. Macau casino shares, one pocket of this market that's really come alive, as you can see on your screens right now. We're talking about some regulations coming through, introducing 6 measures to streamline entry and exit process for Chinese citizens on Sunday. That's boosting this. And also on top of that, property and banks are doing very, very well. Flip the page, please.
Yeah, property was the best day in 5 months that we've seen.
Going back to November last year.
Look at SIFI Holdings. So that was talking about a holistic approach to some sort of restructuring plan here. China Wanka comes up with earnings a little bit later on as well. But also there's these Chengdu relaxing some home buying rules. So a combination of all that, you get this right now here as well. What does it mean for the banks? Certainly, we're watching very closely their exposure to the property sector and their earnings this week as well. We talk about that coming up and throughout the week as well. That's it for us here on The China Show. Bloomberg Markets Asia is next.